You are listening to CEO Perspectives, a podcast by the Conference Board.
Welcome to this episode of CEO Perspectives, a signature series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of timely topics that matter most to business leaders. To help make sense of these topics and how they'll unfold, we'll sit down with thought leaders and do what we do best at the Conference Board, provide trusted insights for what's ahead. I'm Dana Peterson, Chief Economist of the Conference Board, standing in for our CEO, Steve Odlin. Today, we're talking about the Conference Board's latest economic indicators. The U.S. Leading Index, Consumer Confidence Gauge, and Salary Increase Budget were all released. Central banks are hiking interest rates, and the likelihood of recessions in the U.S. and across Europe are rising. Joining me today is Lynn Franco, the Director of the Indicators Program at the Conference Board. Welcome, Lynn.
Thank you, Dana.
Lynn, let's first talk about the U.S. The Conference Board U.S. Leading Economic Indicator fell for the sixth consecutive month in August. What does this mean?
Well, it's not good news, Dana. It's strongly signaling that a recession is on the horizon for the U.S.
Well, tell us a little bit about what's in this index and why we should be so concerned.
Well, when we take a look at sort of the Diffusion Index, which gives us a sort of look at breadth and depth of the 10 components that make up the LEI, what we're seeing here is that this is in negative territory. It's at minus 2.7% of what we consider to be in the red zone and sort of a recession signal.
So given this recession signal, what is the probability of a recession over the next year or so?
Extremely very high. We have a new model which suggests that the likelihood is about 96%.
That's astounding. So when might a U.S. recession begin and how long might it last according to our economic projections?
Well, we're expecting it to start as early as Q4 of this year and linger into Q1 of next year. But there is a slight risk that it may have started even earlier. So we're really monitoring, GDP, personal income, industrial production, and a variety of labor market data to sort of watch for any early signs of a recession.
Thanks, Lynn. So let's talk about consumer confidence. What is our proprietary consumer confidence index telling us about how consumers are feeling?
Well, what we saw this morning is that confidence ticked up for the second month in a row. It's now at 108, up from 103.6. And we saw improvements both across a consumer's assessment of the present situation, which takes a look at business conditions in the labor market, and also their expectations for business conditions, income, and jobs as well. And on top of all of that, which they all came in pretty good, was the fact that we've had much lower gas prices over the last several months, and that's really helping to boost consumer confidence.
So in addition to lower gasoline prices, why else are consumers showing a little bit of improvement in their sentiment, at least in the short run?
Well, the main pillar of support has been the job market. So that has remained relatively strong. We've had pretty high wage increases as well, and those have contributed to this rise that we've seen in confidence over the last 2 months.
Well, if we've seen this improvement in confidence and consumers are being underpinned by high employment and rising wages and certainly a little bit of a break at the gasoline station, do consumers still expect that there's a recession on the way? I know that our indicator was saying that in previous months.
Well, we've seen the expectations gauge come off of summer lows where it was down in the 60s. It's currently at 80.3. It's really hovering around that recession line. So I don't think we're out of the woods yet. And there's probably more headwinds on the horizon that could very well push confidence down in the coming months.
Well, given this concern among consumers that there could be a recession, have we seen any changes in consumer buying habits?
Yes, we have. We've seen a little bit of sort of a divergence where we had a bit of an uptick in the number of consumers who said they intended to purchase a car or big ticket items such as, appliances for the home. But we've got fewer now saying that they intend to purchase a home. And I think that's directly related to the fact that we're seeing interest rates rising and we're also seeing a cooling in the housing market.
Well, there's that really important measure, the inflation expectations gauge. What happened with that measure in the month?
Well, we've seen it now been sort of ticking down for the last 2 months, directly related to the declines that we're seeing at the gas pump. But even though consumers' expectations regarding inflation have cooled a bit, they still remain relatively elevated.
You say that they remain elevated, and certainly the Fed is concerned about not only the actual level of inflation, which is pretty high, but also inflation expectations. How do we see the data playing out in Fed policy?
Well, we've already seen at their September meeting, the Fed raised interest rates by another 75 basis points to help combat elevated prices and help prevent inflation expectations from becoming unanchored. More importantly, what they've signaled is that they're going to continue to raise the Fed funds rate, probably somewhere between 4.5 to 4.75% over the course of the next year. And this is much higher than what we were forecasting, which was the range of 3.75 to 4%.
So, what does it mean?
Well, what it means is that the US recession that we project may actually turn out to be deeper and longer than anticipated.
Hmm. I mean, with all this bad news, are there any upsides for the US forecasts and for the economy?
Certainly, if inflation falls faster than expected, then the Fed may not need to raise rates as aggressively or as high, and this might produce a soft landing that's characterized by minimal damage to GDP or increases in unemployment.
Oh, that's interesting. It seems like the US labor market continues to thrive despite growing recession risks. This is characterized not only by a relatively low unemployment rate, which we've seen in the jobs reports, but also really sizable monthly gains in employment, and also lots of quitting and tons of job vacancies. How are our members managing the pressures of hiring and retaining top talent amid this environment?
Well, what we've seen from many of our proprietary surveys is that firms are raising wages. So these wage pressures are still persistent. In fact, in our newly published salary increase budget survey, that shows that the share of payroll budgets allocated to increases in wages rose both in 2022 and in 2023, may rise to the highest share since 2021. So definitely upward pressure there. And in fact, when you take a look at last year, the actual total increase that was budgeted was for an increase of about 3.6% and actually came in at 4.1%. So the forecast for 2023 is projected to increase even further to 4.3%. And we're seeing very similar results in sort of our CEO confidence survey, where these upward pressures in terms of wages remain.
This is truly fascinating. So, what we're talking about is what sounds like what some are calling a job full recession, where the labor market really doesn't suffer too much because of these labor shortages that we're seeing. But still, in all, we could see material slowing in the US economy in terms of consumption and business investment, and even the contributions from government. So, this is truly fascinating. We've talked about the latest conference board data and also Fed policy. Next, we'll talk about the rest of how the rest of the world is faring. We'll take a short break and we will be right back.
As you and your company monitor the volatile and uncertain economy, the award-winning forecast team at the Conference Board predicts a downturn by the end of 2022. Recession will further compound the crises that have recently upended expectations, from a deadly pandemic to a war in Ukraine and the highest inflation in decades. Yet, unprecedented crises also present unforeseen opportunities if you have a trusted, proven navigator by your side. With that in mind, and as the Conference Board has always done, we are providing you with daily, timely, and relevant content that will guide the business community through the economic storm. These trusted insights are being gathered on our website and are available to help your company master the challenges. To find out how you can chart a course for the future which will allow your business to emerge stronger on the other side, visit our free economic hub entitled Navigating the Economic Storm, your indispensable guide through the global recession, located at conference-board.org/topics/recession.
Welcome back to CEO Perspectives. I'm your host today, Dana Peterson, Chief Economist of the Conference Board, standing in for our CEO, Steve Odland. I am joined by Lynn Franco, who is the Director of Indicators Program at the Conference Board. So what is the outlook for the global economy? Are we still expecting a global recession?
Well, data for major economies like the US, Europe, and China continue to show weakness. And we see that in our own respective leading economic indices for these economies as well. However, we don't believe that a global recession is on the way. We'd need a sort of much more severe economic downturn in these three regions to cause a global recession. And so far, we're just expecting brief and shallow recessions in the US and Europe, and just more material slowing in China, but no recession in that economy.
Let's talk about Europe. Why do we expect a recession in Europe, even if it's brief and shallow?
A variety of factors. First, the war in Ukraine continues to rage on. It's causing a humanitarian crisis, also causing disruptions in European manufacturing, production, and exports, and supply chain bottlenecks. Second, Russia has limited supplies of natural gas to much of Europe. And in response to this, to the sanctions, it's causing major energy shortages and ahead of the winter season. So consequently, food and energy prices have surged, causing many central banks throughout Europe to raise interest rates, and higher interest rates slow demand and thereby GDP growth.
Well, Lynn, which economies are already in recession in Europe and which ones might be close to recession?
Well, Ukraine and Russia are already in recession due to the war and sanctions, respectively. Germany and the United Kingdom are at least appear to be on the cusp.
Well, when do you expect Europe more broadly to go into recession?
Much like in the US, over the fourth quarter of this year and first quarter of next year.
Well, what factors might make conditions in Europe worse than expected?
The escalation of the war in Ukraine, the use of unconventional weapons, for instance, higher energy price inflation, and thereby, interest rates increases by the central banks.
Well, again, what might be an upside for Europe?
Well, governments are doing what they can to ration energy and also to lower energy prices. So this may help support consumer and businesses suffering from higher prices. There might be fiscal stimulus, which could help as well. Also, governments are importing more natural gas from other economies apart from Russia. So maybe a variety of these actions might help lower inflation sooner rather than later and help Europe avoid a recession.
Well, let's hope that happens. Let's talk a little bit about China. Why do we expect slow growth but not a recession?
Well, China is experiencing slow growth in 2022, for three reasons. One, we have the repeated COVID-19 related lockdowns. There's been a correction in its housing market and weaker exports as demand in the US and Europe has faded. Worse outcomes than expected among these factors could push China into a recession, but this is not our base case because the government and central bank are deploying monetary and fiscal policies to help support the Chinese economy.
That sounds really depressing for this year. What about next year? What do we think will happen?
Well, we think the situation may improve in China as consumers increase spending on services, and this should be facilitated by the rollout of new vaccines now under development, and maybe some relaxation in China's dynamic zero COVID policy could be helpful.
All right. Well, it sounds like for the global economy, we're not expecting a recession, but we could have recession in some of the big regional economies like the US and Europe, and certainly some of the larger economies within Europe, but no recession in China, but certainly quite a bit of weakness. So this has been a really great conversation, Lynn. So there's a very uncertain future that awaits us. But Lynn, thank you again for joining us today.
Great to be with you.
And thanks to all of you for listening to CEO Perspectives. Every week, we'll be joined by a prominent thought leader to provide insights on the issues of our time. We'll cover the leading topics in geopolitics, economics, public policy, ESG, human capital, and more. Please share CEO Perspectives with your colleagues. I'm Dana Peterson, and this series has been brought to you by the Conference Board.
You've been listening to a podcast from the Conference Board, the indispensable ally that has helped businesses through war, recession, and economic transformation for over 100 years. As recent unexpected economic challenges persist, you can chart a course for the future which will allow your business to emerge stronger on the other side. Just visit our free economic hub entitled Navigating the Economic Storm, your indispensable guide through the global recession, located at www.conference-board.org/topics/recession.